So, what makes a stock price change? The answer to this question can be as simple or as complicated as one wishes it to be. At the most basic level, stock prices move as a result of what we call market forces. Market forces is a word used to describe supply and demand. So, a stock will move depending on its demand versus its supply. If more people want to buy a stock, which is the demand, than sell it, which is the supply, the price will move higher. But on the other hand, if more people want to sell a stock than buy it, there would be greater supply than demand. Consequently, the price would fall. As William O'Neill, a very famous stockbroker, said, "It takes big demand to move supply up, and the largest source of demand for stocks is by far the institutional buyer." When the major investors in the market act, they exert tremendous influence over stock prices. So those are institutions such as mutual funds, pension funds, banks, etc. They exert the force due to the sheer size of their orders on a stock. These large transactions tend to drive prices up or down depending on the degree of buying or selling. How can you tell if people are buying or selling a stock? Well, there's this metric called volume. The volume of a stock basically tells you the number of shares being traded during a period of time. Therefore, a large increase in volume percentage can indicate increasing demand from those institutional investors. This is followed by increasing share prices. Keep in mind that institutional investors aren't the only ones who can make stock prices change. Regular investors can too. It's just that it would take more investors to deploy the same amount of capital as institutional investors do. Understanding supply and demand is easy. Where it gets a little more complicated, though, is figuring out why people like or dislike a particular stock. The reason why it is so difficult to understand is because every investor has his or her own strategy, which they execute. But all in all, this comes down to figuring out what news is positive or negative for a company. The principal theory is that price movement of a stock indicates what investors feel a company is worth. If you remember from a few lectures back, that is market capitalization. To further complicate things, the stock price doesn't only reflect a company's current value, but also it reflects the growth that investors are expecting in the future. By far, though, what affects a company's value are its earnings. Publicly trading companies are required to report their earnings 4 times a year, once each quarter. Since most of those companies report them during the same time, investors call those periods earning seasons. Investors watch company earnings with a lot of attention. If a company's results are better than expected, the stock price will jump. But if a company's results disappoint, the price will sink. Obviously, earnings aren't the only way that public sentiment can change concerning a stock. A famous example is the 2000 dot-com bubble, when dozens of internet companies rose to have huge market capitalizations without making the smallest of profit. As you might already know, the valuations did not hold, and those companies saw their stock prices plunge and valuations shrink. The fact that prices moved that much shows that there are many other factors besides earnings that can influence a stock. So, in conclusion, what makes a price change? Well, no one really knows for sure. Some think that it is impossible to predict how prices will change, while others use different strategies to figure the next move, which is what we will be looking at in the next lecture. The most important concepts to grasp from this video are: number 1, stock prices are fundamentally driven by supply and demand, which in a way you can look at as public sentiments. Number 2 is that In theory, earnings are what affect the valuation of a company, but there are other ways investors use to predict stock prices. But something important to remember is that investor sentiments and expectations are what ultimately affect a stock price. In this lecture, we will be looking at the stock exchange, where nearly everything stock related happens. I say nearly because there has recently been a huge shift to online investing without the actual use of the physical exchange. But we will come to that later. We will also be looking at the different types of markets, the primary, the secondary, and the OTC, or over-the-counter markets. The stock exchange is an exchange for stockbrokers and traders to trade stocks. The function of an exchange is to ensure fair and orderly trading, as well as the dissemination of price information of any stock on the exchange. The exchange gives companies a platform to sell their stock to the investment public. In order to trade a stock, it must be listed in the exchange. There usually used to be a central location for record keeping, but it is currently becoming less linked to a physical place as markets are now electronic networks, which gives the advantage of speed and reduced costs for transactions. The trading on the exchange only happens with members, so brokers and dealers, basically. When a company chooses to go public, they go through an IPO, which stands for Initial Public Offering. This process is done in the primary market. The primary market is the market that issues new stocks on the exchange. It is facilitated by what is called an underwriting group, which is basically an investment bank that sets a beginning price for the stock and sells it to the investors. Once the IPO is done, the actual trading of the stock happens in the secondary market, which is the stock market. In addition to the primary and secondary market, there are also the third and fourth markets. They aren't as important because they don't concern the individual investor. All they do is make market transactions between brokers and dealers, as well as large institutions, through what we call the OTC market. The OTC market is a decentralized market, which means that it doesn't have a central location. The transactions occur through various communication modes, such as through the telephone or by email. OTC markets are much less transparent and are subject to fewer regulations. Let's take a look at the history of the exchange. The first real company that issued shares was the East India Company. The shares were issued on paper, so investors could then sell the paper to other investors. At that point, though, which was during the 1600s, there was no real stock exchange in existence, so investors would have to track down a broker to make a trade. In London, though, brokers and investors would meet and do business in coffee shops. The first stock exchange in London was created in 1773, 19 years before the New York Stock Exchange. At that time, though, the London Stock Exchange was forbid to deal stocks, while the New York Stock Exchange could from the very start. The New York Stock Exchange actually has a rather interesting history. It was formed by brokers that used to deal under a buttonwood tree, which was located on Wall Street. The reason why it grew to be the most powerful exchange was because of its location. It was in the heart of all business and trade coming and going from the United States, as well as the base for most banks and corporations. Back in Europe, the London Stock Exchange emerged as the leading exchange in Europe. Exchanges are located all around the globe, with some of the more famous ones being the New York Stock Exchange, the Nasdaq, and the Tokyo Stock Exchange. The New York Stock Exchange is primarily auction-based, with specialists being physically present on the exchange trading floor. Each of these specialists specializes in a particular stock, buying and selling it in the auction. There is an ongoing rivalry between the specialists and the electronic-only exchanges that claim to be more efficient because they are able to execute trades much faster by eliminating human intermediaries. The Nasdaq is another large exchange in the US. It is an electronic exchange and sometimes called screen-based because buyers and sellers are connected only by computers. To sum up everything, we looked at how exchanges work as well as their history. We also looked at the functions of the primary, secondary, and OTC markets. So, I hope you enjoyed it, and thank you for watching.